Right. Hi everyone. So yesterday we were able to discuss the accounting adjustments related to sole proprietorships. Right. So we did we started with the components and the elements in the accounting process, how we prepare financial statements from the trial balance. Then I was explaining the important accounting adjustments, inventory, trade receivables, and accruals. And inventories, the closing inventory, the cost and the net realizable value. Then the debtors or trade receivables related adjustments, the bad debt, provision for doubtful debts, special provision, and general provision. Then we did accruals related to expenses payable, and prepaid expenses. Then I did income receivable and income received in advance. Okay, so what I'm going to do today is let's prepare basic financial statements with adjustments using the trial balance. Okay, I'm going to do this question in traders. So you all can do the question with me. In traders. Okay. So let me read the question. NN Traders is a sole proprietorship owned by Nishanthan. The trial balance of NN Traders as at 31st March 2017 is given below. So we have a trial balance. 31st March 2017. Right? The property, plant and equipment, accumulated depreciation, stock, receivables, payables, drawings, provision for doubtful debts, purchases, sales, showroom rent, electricity, water, salaries and wages, office maintenance, cash at bank, cash in hand, advertising, and opening capital. So this is the trial balance. Right. So initially we will understand the basic preparation of financial statement, and the same thing will be used for incomplete records, company accounts, partnership, non-profit organizations, right? So for everything, you need this basic knowledge. The following additional information is provided. So the first adjustment is the closing stock. Cost is 5.4 million. Net realizable value is 5,450,000. Value of land is 4 million. And depreciation policy of the business is depreciate the property, plant and equipment on straight line basis at cost using the following rates. These are the rates for depreciation. Nishantha is the owner. He decided to write off the balance receivable from Ruan amounting to 500,000. So this is a bad debt. This is a bad debt. Okay. and the general provision is 5% from the remaining trade receivables. So we have done this yesterday. So we can apply the method into the financial statement. Nishanta opened a new showroom on 1st of April 2016, and the rent for the new showroom is 150,000 per month. You are required to prepare this statement of comprehensive income and the statement of financial position. This is profit and loss. Okay. So first thing is let's draw the formats. We need the statement of comprehensive income and the statement of financial position. Okay. So y'all can do the question with me. Draw the format. Here. Okay. So this is the basic format for the statement of comprehensive income or the profit and loss. NN traders always try to write the full name of the statement. NN traders statement of comprehensive income for the year ended 31st March 2017. We are preparing in thousands, so don't forget this 1,000. Sales, cost of sales, other income, administration expense, distribution expense, finance expense, other expense. With the net profit. Statement of financial position, non-current assets. We can have 3 columns: cost, accumulated depreciation, and the book value. Then current assets, you get the total assets. Equity, non-current liabilities, and current liabilities. Then you get total equity and liabilities. Can you all draw the format? I will give you 3 minutes. So let's start writing the answers. Okay, so this is a basic question. Okay, but when we do the complex ones, this understanding the basic is very important because we are using the same technique. Right? We are using the same technique for all the questions. Right. So when you get a question like this, normally you will get a trial balance and adjustments, trial balance and additional information. You will get the trial balance and additional information. So when you get a question like this, number one, first thing is you need to draw the format. Number one is draw the format. Okay. All right, the steps. Steps. Number one. Okay. Then the second step, additional information. That format, then additional information. So additional information, always you have to record the double entries. Additional information, always double entries, 2 entries, because they are the adjustments. Number 3, the information in the trial balance. Only single entry. Information in the trial balance, we have to record only once. Number 4 is balancing. Number 4, we need to balance all the accounts. These are the 4 steps that we need to do. Okay, so format is done. Format is done. Now let's do the additional information. There is a question. So this under sole proprietorship. Yes, these are for the sole proprietorships. We are preparing accounts for sole proprietorship. Okay. Chapter 6. This is on sole proprietorship. Okay. Now let's do the additional information. Right. Number 1. Following additional information is provided. Number 1. Closing stock as at 31st March 2017 is valued as follows. The cost is 5.4 million. Net realizable value, selling price, expected selling price is 5,450,000. So we will take the cost because we have to take the lower of cost and net realizable value. So we need to take the cost. Okay, we need to take the cost. Cost is 5.4 million. What is the double entry? Stock account debit. Stock account means the current asset. Inventories. 5,400. Then cost of sales here 5,400. So double entry will be recorded in the financial statement. Entry 5,400. You have to take the lowest Since the cost is low, there is no loss. This goes to two places. Right. Now let's move to the second additional information. Right. This is also very important. Value of land is 4 million. And the depreciation policy of the business is to depreciate the property, plant and equipment on straight line basis at cost using the following rates. Building 10%, office equipment 20%, furniture and fittings 25%. So when you have the depreciation, what you do is first record the cost in the statement of financial position. Land, equipment, furniture and fittings. So let's write them. The statement of financial position. Land, building, equipment, furniture. We are doing this. Okay. So how much is land? Land value is 4 million. 4 million. Then what is the cost of the building? What is the building cost? Land and building both 10,000. Land and building both 10,000. So if the land is 4,000, building is 6,000. 6,500. Furniture 5,000. Get the total. Okay. Now you need to calculate the depreciation. 10%, 20%, 25%. So remember, we don't depreciate land. So no depreciation for land. Building, office equipment, furniture and fittings, we need to depreciate for the given rates. So all three administration expense. Can you all calculate the depreciation for each asset? Okay. Calculate the depreciation for the given rates. 10%, 20%, 25% on cost. Building cost is 6,000. Office equipment 20%. Furniture and fittings 25%. Calculate the depreciation here. So what are the values? This is 600. Then 1,300. 1,250. 1/4. Okay. Now the accumulated depreciation. So what is meant by accumulated? Accumulated means added the total depreciation. That means previous year depreciation plus this year depreciation. So here we have accumulated depreciation as at first step 2016, and we have already calculated current year depreciation. Then total accumulated will be this building 2,600 plus 600. Office equipment 1,500 plus 1,300. Furniture and fittings 2,500 plus 1,250. So can you all complete this? 2,600 plus 600. 1,500 plus 1,300. 1,250 plus 1,250 plus 1,250. Get the total. It is 1,500 plus 9,750. Then also calculate the net value and get net book value. Get the net book value. Okay, so net balance we can calculate. 4,000, 2,800, 3,700, 1,250 and 11,750. Okay, I hope it's clear. So for all the questions, we follow the same method. Okay, so there can be additionally, there can be disposals, new purchases, right? And also reducing balance method depreciations. Okay, so later I will explain that. Okay. Now, the third adjustment, number 3. Nishanta decided to write off balance receivable from one amounting to 500,000 as bad debts and general provision 5% for doubtful debts should be made on remaining trade receivable balance. Bad debt is 500,000 and doubtful debt is 5%. Debt is 5%. Okay, so it's very simple. Trade receivable. Trade receivable minus provision for doubtful debts. Okay, so here under current assets, first let's write trade receivables minus provision for doubtful debts. And if we check the trial balance, there is trade receivables. $18,000. It's debit. Trade receivables 18,500. And there is a provision for doubtful debts 750. Provision for doubtful debts 750. There is no bad debt. Okay. So two opening balances. What normally we can do is here we will write within bracket the opening balance 18,500. Provision for doubtful debts, it's 750. I'm writing the opening balance. As I have said earlier, trial balance information only one place. Additional information 2 places. Okay. First, record the balances, opening balances. So I am not preparing the ledger accounts. I am doing this in the financial statement itself. And it's easy. You will save your time. You will save your time. Okay. So first thing is there is a bad debt of 500. Bad debt 500. What is the double entry for bad debt? It's debtors account minus credit 500. So we deduct 500 from the trade receivables. We reduce 500 from the trade receivables. Debtors account credit. And it is a distribution expense. Bad debt. So we take bad debt 500 to the distribution expense. Debtors account credit 500. Bad debt account debit 500. Then from the net value, general provision is 5% on the remaining trade receivable. So this is 18,000. So how much is the doubtful debt? Doubtful debt. Tell me how much is the doubtful debt from the remaining debtors, from the remaining trade receivables? 10%. How much is 10%? Sorry, it's 5%.
900.
900. 18,000 into 5%. So that is the doubtful debts. 900. Okay. So you can see here already there is a balance of 750. Already in the provision for doubtful debts account, there is a balance of 750. So this should become 900. So to make this 900, what you have to do? You have to increase this by how much? Increase this by
150.
Yes. So this becomes 900. If you increase the doubtful debt, so this is called under provision. You have a less provision in the doubtful debt account. So you are increasing the provision by 150. Increasing the provision means it is an expense. So we take distribution expense, doubtful debt, under provision. How much? You take 900 or 150?
150.
You take only the increment. Yes, 150 to take the increment, not the total amount, because already last year 750 was taken. Last year 750 was taken. That is why it is brought forward in the trial balance 1st of April 2016. This year we have to increase it by another 150. Then get the net debtors 17,100. Okay. So I hope that's clear. To take any question, you have this doubtful debt adjustment, bad debt and doubtful debt. Let me know how to record it in the ledger account, and directly we can do this in the financial statement. So no need to prepare the ledger accounts for this. You can directly do it here. Okay. Then we have one last adjustment. Nishanta opened a new showroom of NN Traders on 1st April 2016. That is beginning of the year. He has opened a showroom. For the new showroom, the rent is 150,000 per month. 150,000 per month. Then what is the total rent? Showroom rent. What is the total showroom rent?
1,800.
1,800. Yeah. 150 into 12 months. 150 into 12 months. Then 1,800. That's the showroom rent. Total showroom rent for 12 months. Okay. Now we can see how much showroom rent is paid. Showroom rent. Only 1,500 is paid. Only 1,500 paid. So this is a distribution expense. Showroom is used for sales purpose. Okay, so showroom rent is distribution expense. 1,500 already paid. $1,500 already paid. Total is 1,800. How much is payable? How much is payable? Yes. Yes. 300 is payable. So we need to increase this by 300. And the 300 is a current liability. Keep one space for trade payables. And after that, we can report rent payable. Showroom rent payable. 300. Right. So the total amount goes to income statement. 1,800. That's all. So that's how we prepare the financial statement. and take the remaining balances from the trial balance. Opening stock 2,800. Take here. Trade payable 16,600. Current liability. Drawings 1,300. Okay, you will get capital plus the profit. Minus 1,300. Purchases 20,000. Sales 37,000. Electricity, water, salaries, maintenance. Okay, take few minutes and complete this. There's a question. Okay, so we have three columns down here. We have three columns. This heading is now cost, accumulated depreciation, and book value. These three columns are only up to this. These headings are only for these three. These non-current assets. After that, this is only for calculations. We have columns only for calculations. So you put everything. If you don't have any calculations here, you can directly write in the second column. So you can take other balances to the second column. Electricity, water, salaries, and wages. Office maintenance. All comes under administration. And there is advertising expense. Cash at bank, cash in hand. Right. Tell me what is the total asset, what is the net profit, and the balancing amount, total assets and total liabilities. Okay. So it's complete. Electricity 2,550, water 1,500, salaries 3,500, maintenance 1,650, advertising 1,100, cash and bank 3,700, cash in hand 1,900, capital 20,550. That's all. Cost of sales, gross profit, and find the net profit 3,700. That comes here. So 39,850 and 39,850. Perfect. Total assets. Okay. And then this. So you can complete this. Fine. Are you all done? Shall we move to another question? You need more time. Right. So let's move on to another question to understand the format, the basic adjustments. Okay. So let's do this question. KPM Traders is a sole proprietorship owned by Sam Silver. Let's do this question. Let's do this question. Okay, so let's start this question. KPM Traders is a sole proprietorship owned by Sam Silva. As of 31st March 2019, we have the trial balance. PPE, accumulated depreciation, stock, sales, purchases, electricity, water, receivables, payables, stationery, salaries, rates, bank loan, holding, doubtful debt, overdraft interest, capital. Additional information, closing stock, 1850. Depreciation, building, vehicles, equipment. Write-off 100,000 as bad debt. General provision 10%. Electricity payable 143. Bank loan was obtained on 1st of March at the annual interest rate of 12% per annum. First installment was paid on 2nd April. Interest payable for the year ended 31st March was not accounted. Rates paid is relevant for the period 1st of January to 31st December 2019. We have to prepare income statement 31st March 2019, statement of financial position 31st March 2019. Okay, so let's draw the format. Then I'll draw the format and start. I'll give 5 minutes for you all to do this question. Row and start doing the adjustments. So it's very important to understand the basic, because most of the students I have seen, right, they are struggling to prepare the financial statement for companies, financial statement for partnership, because they don't have the basic knowledge, basic understanding of closing stock, depreciation, right, bad debt, doubtful debts. But if you have the basics, then the companies and other areas would be easier. Okay, because when you take depreciation, once you know the depreciation part, then you can do disposal, purchases, depreciation calculation for straight line, and reducing balance method for different time period. Okay, so that is why the foundation, the basic part, we need to have the full knowledge. So let's start. This here. This is the format. Right. So we can start with adjustment number one. Adjustment number one is always the closing stock. The closing stock as at 31st March 2019 was valued at 1,850,000. Closing stock. The cost is 1,850. So the double entry, one entry goes to the cost of sales minus 1,850. Current assets is 1,850. Okay, so when you record these two, you will get about 2 marks. 1, 1. Correct. Next, the policy of the business is to provide depreciation on straight line basis at cost as follows. Building 10%, motor vehicles 20%, office equipment 25%. Okay. Then we will record the cost of the property, plant and equipment, land and building. Land is 3 million, so the building will be the remaining 5 million. Motor vehicles 2.2 million, office equipment 1.1 million. We can write the cost. Land, building, equipment and furniture. Then the cost. $4,000, $6,000, $6,500, $5,000. Total 21,500. So I'm doing the non-current assets part. So, and building, motor vehicle, office equipment. Land should be 3,000. 3,000. 5,000. 2,200. 11,000. Then the depreciation. Let's calculate the depreciation. Building, motor vehicle, and office equipment. Building depreciation is administration. And office equipment also administration. Motor vehicle is, remember, motor vehicle we normally take under distribution expense. 10, 20, 25. Only 5,000 into 10%. 5,000 into 10%. Equipment is 25%. Equipment 1,100. 25%. Motor vehicles 2,200 into 20%. 500. For 40. So let's move to the accumulated depreciation part. Accumulated depreciation, building 1200, motor vehicles 400, equipment 225. So we can take the total 1200 plus, so more depreciation for land, building 1200 plus 500, 1700, motor vehicles 400 plus 440, then total 840, equipment 225 plus 275. We can get the total. Book value is equals to cost minus accumulated depreciation. Cost minus depreciation. Total sum 8,260. 8,260. Okay, so moving to the next point. The management decided to write off 100,000 from the trade receivable as bad debt and to make general provision of 10% for doubtful debt on the remaining trade receivable balances. 100,000 bad debt. Trade receivable. Provision for doubtful debts. Trade receivables 2,800. Provision for doubtful debts 170. These are the balances. So first thing, take those two balances into the SFP 2,800. Doubtful debt 170. One entry for this. Okay. Then 100,000 we need to make as bad debt minus 100. So double entry for that 100 is trade receivable account credit and distribution expense. Bad debt 100. Here it's minus and it is an expense. Then from the remaining trade receivables, remaining is 2,700. From the remaining trade receivables, we need to make a provision of 10%. Provision of 10% as doubtful debts. So like we did in the previous question. Yeah, 2,700 into 10% is 270. 270. Is it under provision or over provision? Is it under provision or over provision? Yes, it is under provision. So we need to increase this by another 100. We need to increase this by another 100. So that is doubtful. Under provision. Under. 270. So that completes the trade receivable adjustment. Okay. Now, next. Electricity payable for the month of March, 143,000 was not recorded in the books of accounts. So this is a payable balance, electricity payable. Electricity is administration expense. Payable is a current liability. Okay. Electricity here. 1,200 is there in the trial balance. So first we can write that electricity 1,200 in the trial balance. Electricity 1,200 is the trial balance, right? And payable is 143. 143 payable. Yeah. Electricity payable 143 was not recorded in the books of accounts. We need to add 143. 1,200 plus 1,200 plus 143. We add increase paid plus payable. You get all. And also we have to take this under current liabilities. Electricity. Payable 1. Next. The bank loan was obtained on 1st of March 2019 at the annual interest rate of 12% per annum. First installment of the loan has been paid on 2nd of April 2019. The interest payable for the year ended 31st March was not accounted in the books of accounts. Okay, first I will explain what is the meaning of installment. Right? Because most of the students, they get confused with installment and the interest. So if you take the installment has two parts, right? One is the capital portion, other one is the interest portion. When you repay the bank loan, there is a capital portion which will be deducted from the initial loan amount, right? And there is an interest portion which is an expense. So interest portion goes to income statement or you can say profit and loss. And this capital portion will be deducted from the liability of the loan account minus from the loan account. Okay, right. Now, what is our question? A bank loan was obtained on 1st of March 2019. 1st of March 19. Our financial year end is 31st March 2019. Right. So there is 1 month for the year end. First installment of the total one was paid on 2nd of April. So we have paid the installment next financial year. We have paid the installment on next financial year. So this year, for this financial year, the interest is accrued. For current financial year, the interest is payable. Okay, so we need to calculate the interest and record it in the financial statements as interest payable. Can you all tell me how much is the interest payable? Interest payable. How much is the interest payable? Loan amount is your bank loan is 900. Loan amount is 900. Interest rate is 12%. Into 1 month. What is the value? I got only few answers. How about others? Yeah, it's 9,900. It's 9,000. Okay. So, 9,000 interest. Double entry for the interest is interest expense account debit, interest payable account, finance expense. You can write bank loan, interest 9,000, bank loan, interest payable 9,000. Right. There is a question. Can you explain the interest payable? Okay. So interest payable, always what you need to do is check the date that you obtain the loan, right? Date obtain the loan. When did you take the loan? Then from that date to the year end, from that date to the year end, you see the time duration. How many months? So here there is 1 month. 1 month. So that 1 month, calculate the interest. Yeah. From the loan taken date up to the year end. Total number of months. Okay, so that entire amount will be expense. That entire amount is expense. Then you need to see whether is there any payment during the current financial year. So here there is no payment during the current financial period. The payment was done on 2nd of April, next financial year. The payment was done in next financial year, right? And we prepare the financial statements on accrual basis, not on cash basis. So end of the year, it is payable. As of 31st March 2019, the interest and the capital amount totally payable. Okay. Therefore, the interest is calculated as a payable amount. Total interest expense account debit, interest payable account credit. Then what about the installment, the capital portion? What about the capital portion? Do you need to deduct it from the bank loan? So bank loan is done. Will you deduct it? We don't deduct because capital payment is done next financial year. End of the year's total amount is payable. Is it clear? Take the total amount as the bank loan, non-current liability. Calculate current year interest. Current financial year interest. That's a question. And if they paid in financial year, we need to deduct it. Yes, if the payment is done during the current financial year, if the payment is done during the current financial year, then from the bank loan, you have to deduct the capital portion. From the bank loan, let's say if the payment is done in the current financial year, let's say the capital portion is 100, then from the bank loan 900, you have to deduct 100 and only 800 will come here. Interest payable also, if it is paid, if the total interest is paid, there is no interest payable if it is paid. But in this question, the payment is done in next financial year. Okay. Next. The last one. Rates paid is relevant for the period from 1st January to 31st December 2019. Okay, so this is also a very important question to understand the prepayments. Prepayments. Let me explain. Now, this is our financial year. First of April 2018, 31st March 2019. This is the financial year. Then this rates paid from 1st of January. Yeah, somewhere here. 1st of January 2019 to 31st December 2019. Rates paid for 1st of January 2019, 31st December 2019. So how much is the rate? Rates paid 180. Okay, total 180. So 180 is paid for 12 months. 180 is paid for 12 months. Out of these 12 months, current financial year belongs to current financial year. How many months? 1st January to 31st March, only current financial year. So here, only 3 months belongs to current financial year. Then 9 months for next financial year. This is called prepaid. Can you all tell me how much is the prepaid rate? Prepaid rates? Total 180. How much is the prepayment? Tell me. Prepayment. Out of 180. Divide by 12, so you get 1 month's rent rates. 9 months prepayment. Yes.
135.
135. Yes. So prepayment is 135. It's the prepayment. Prepaid rates. Is it clear? Because in most of the missions you will have accruals and prepayments. Let me explain again. Now in the question, our financial period is starting from 1st of April 2018 to 31st March 2019. Then they are saying rates paid relevant for the period from 1st January 2019 to 31st December 2019. 1st of January 2019 to 31st December 2019. Okay, so that means we have paid a part of the rates for current financial year, another part for next financial year. Current financial year means it ends on 31st March 2019. So only 3 months belongs to current financial year. 9 months for next financial year. Next financial year means it is prepaid. So total 108,000. Out of that, 9 months prepayment, which is 135. Is it clear? Okay. Now similar to what you did for the payable. Payable was added to the expense and it has taken under current liability. Prepayments will be deducted from the expense and taken under current asset. Okay, let's take rates. Rates 180. Rates out of 180, 135 is for next year. So only 45 belongs to current financial year. The one is prepaid. Prepaid rates 135. That's all. Huh? Yeah. Now record the remaining balances. Opening stock is 1,800. Sales 25,200. Okay, I'll give you some time. Complete the question. If you all have any doubts, you can ask now. Others can complete, calculate the net profit and the total assets and liabilities. There is a question. Why are we multiplying interest payable amount by 1 over 12? 1 over 12 means dividing by 12, calculating for 1 month. Because if you just calculate 12%, 12% is for 1 year. Annual interest rate is 12%. So if you want to calculate for 1 month, you have to multiply by 1 over 12. If you want to calculate for 2 months, you have to multiply by 2 over 12. 6 months, 6 over 12. That's the reason. bank overdraft. Bank overdraft is a current liability. Overdraft interest is a finance expense. Overdraft is a current liability. Okay. Stock sales 2500, purchases 15,500. Always try to follow the method, the steps which I'm doing. First, draw the format, then additional information, then trial balance, then you can come 4 steps. Then it's easy and you can do any question in this method. Water 350, trade payables 1900, stationery 150, salaries wages 1250. Bank overdraft is a current liability. Bank overdraft 1350. Overdraft interest is a finance expense. Interest, this expense. Capital 3295. What is the net profit? $9,070. It's not loans. Well, 6, 7. Okay, so you complete this, and there are more questions in the tube. Already shared the tube. Write down the questions in the tube. And if you don't have any doubts, any questions that you think you want to explain, just drop me a WhatsApp message. Okay, I will discuss. And also, we will be starting another session for MCQs. So next week onwards, we can do the MCQ sessions as well, other than our normal class schedule. Okay. So we'll conclude from this. I'll see you in the next class. Okay. Take care. God bless you.